Okay, welcome guys to this might be the final one. If not, we'll have another one tomorrow, depending on how long this one is going to take. Yeah. So this is going to follow up from what we did yesterday. Can you just confirm that you can hear me and that you can see my screen? Yeah. Okay, good. So yesterday we were looking at the setup. The most exciting part of any strategy is going to be the setup, when we can pull the trigger. And we covered everything else, your analysis before, and the analysis is the what, the where to look for it, and then the quality of that what and where is the important thing, and that is probably going to be the thing that helps you most with the probability that the trades are going to work out better for you. The rules are there so that you can know exactly what it is to look for and to ignore what is not a perfect looking setup. The rules doesn't mean that because it's a good looking setup that it's going to win. The rules are there so that you can quantify what it is that made that a good trade, and then just continue taking that sort of setup. Because sometimes the quality one doesn't work out, and the one that is of no quality works out. So it's got nothing to do with anything. Yeah, this gives us confidence when it looks good, so that we are able to stick to the strategy. And that is more trading psychology. Hopefully Mark can tell us more about that a bit later on. So what we need for quality is going to be two different things here. Because quality comes in the form of where it appears on the chart. That is quality. So when you're doing your setups, hello there, Mr. Parker. So when you're doing your analysis and you're trying to find out what's going on, and you're looking at like a 240, you're finding your area of interest or point of interest or somewhere on the chart that you like, the quality of that is going to depend on like pullbacks and trend lines and all of that. So in between here, we don't like it, but as soon as it gets down, then it becomes now quality. We are looking at a quality area. So quality comes in two parts. The area on the chart that you like, that you found good, and the other part of quality is going to be the actual look of the setup. And that is what we're talking about now. How the 1, 2, 3, how the ABC is looking. That is the ABC. How does it look? So that's the two things that we need to concern ourselves with when we are talking about quality. So no matter what, on your M3, you're looking for a break of your M6 line. Then you're looking for at least a 2-candle, a 2-brick pullback, and then a white brick for the entry. The point here is called the point. When prices are going up, it's breaking through the trend line. It comes down to a point. Now, we don't know when this point is until we get a white candle that goes against this move here. Then it forms the point. So usually on the first one, after the break, the point comes below all these EMAs. We like that. And then about 5 pips below this is where we would like to put our stop losses plus the spread. So it's maybe 6 pips. And then our entries here, which is the white candle, the white brick, about a half a pip or so above there, so that you're taking into consideration the spread here as well. So you're putting in your buy orders a little bit above this white candle. So that's your point in this case. But when we look at like the second one here, this is the point here, but your EMAs are below. So in this case, we are going to put our stops below the EMA here. This is our entries for this one, yeah. That is our stop losses for this one. Another example here. This is your trend line that's broken. Now, one tip on the quality is that you're getting a Justin prominent break here. The break needs to be clear. It needs to look as if it's really broken here. And the pullback needs to be your 2 candles, and that's your entry above your white candle. Your stops are below there. Now, this is the last kiss. It's also called, it's a strategy called the last kiss, and this derives from that. So prices are going up, and the breakout traders are here, and they've broken out. They are jumping in without any confirmation. They're just putting their entries here and they're going. We're looking for confirmation. And this is our confirmation, comes in the form of a retracement and then your entry candle. But if your point comes and kisses the trend line here, then that is a beautiful looking setup. Then that is quality. Prices are going up and you've missed the trade. And then prices comes back down, kisses the trend line for one last kiss goodbye before it goes. This is where that comes from. Another thing about quality is that the retracement here, the pullback, which is 2 candles minimum, if you're getting a 50 to 78% pullback, then we are loving it. Then that is quality. Then that is a quality looking setup, a quality ABC, a quality 1, 2, 3, a quality break pullback. So that quality plus the area that we are trading in is what we are looking for all the time as we are trading. Because if we pull the triggers on lesser quality, then we are using up our leverage on bad looking trades. Then later on, you'll see a good looking setup that you can't take now because you're already in a bad looking setup. So try to find quality setups. So far, do you have any questions on this part so far? Okay, so more on quality. This is another part that's very important here. So the last points here before prices goes up, prices makes a low and makes another low. So we don't have anything yet because we're looking for breakouts. Yeah, this point here versus this point here. As prices are coming down, what is the relationship between these 2 points? Before it breaks through any sort of trend line. So if we can get a Fibonacci, any of these three, the relationship between this low and the next high, and you draw your Fibonacci, and you see that this is either a 123.6 or 161.8 or 78 pullback, the relationship between the 2 points here and that break. You don't have a pullback yet, you don't have anything yet, but it's a potential for a very good setup. We're going to try and go over more of this later, but when it breaks the line here, starting to form the potential setup, starting to perhaps get that pullback, we already know that we have quality because of the relationship between these 2 points. Yes, this is going to be on your entry, Justin. It's going to be on your M3 for your entry. Now you have a setup happening. You have a break, prominent break. You have a pullback of at least 2 candles. It comes back to 50%. Your point now is below all your EMAs here, and you get your entry candle. But before seeing all that, you already saw these 2 points happening, and you had one of these Fibonacci levels. That makes this thing a good entry. In this case, Dalvin, the entry is going to be this next white candle here. Prices goes up, it pulls back at least 2 candles. Yeah, so you haven't traded yet. You're waiting on this white candle to close. And when that white candle closes, you have your entry targets maybe about 1 pip or a half a pip above this is your entry. And your stops are 5 pips below this one here. 5 pips plus the spread is better. Have you got it, Dalvin? This structure broke here on your M6 already, Dalvin. And now this is the M3 chart. It's broken up. Prices has gone up. We are not in the trade yet. We are waiting for this retracement of 2 candles. When we get this retracement of 2 candles, then we are looking to enter in on this white candle with your entries just slightly above that white candle would be good. Yes, Mark is reminding me that we need to wait for this candle to close. Yes, sometimes it doesn't close and it turns red and it goes all the way back down. Yeah, so this is just a good idea. A trade that worked out well. Yeah, our stops are in this case about a few pips, 5 plus spread below that, and then that is where you wouldn't have been stopped out on this move down here in this example. Let me go through. This is what I call the difficult example, and it's a bit complicated. So watch this video again, and hopefully during the live sections of this, we need to go over more of the examples, because the trading is random. We don't know when this thing is going up and down. Yeah, I believe it's random. Yeah, but there are people doing business here for various reasons. And we're not going to get into that now, because then this is going to be too long. Okay, so what we have here is a M3. So we are supposed to be going short here, right? Because we've got an M6 breakout and everything's working out perfectly here. Yeah. So this is structure. It's broken. And we didn't get a nice pullback immediately. This is what we like. Let me just draw this. We like when we get breaks and the pullback happens immediately. We like that because we like the last kiss there. In this case, that doesn't happen. In this case, we get a massive long move down first and then a move up. So now we are looking for a red stick to come down there and entries there with stops above there. But now this is going to be a lesser quality. So if we were trading 0.3 as our maximum, 0.2 as our midpoint one, and 0.1, this is percent, then this would be a 0.2 entry because it's not close to the lines there at the bottom. Sorry about this. Delete that. Yeah. Do you understand that? The various qualities here. The best quality would be that we're getting our break pullback closer so that it can more or less try to kiss the line there. In this case, it's come down. People's taken profits already. You know, we've really missed it. Taken their profits. People are starting to take profits and buy. And then here it's again now 50%. So that would be our secondary risk level. Guys, you can ask questions. You don't have to be intimidated. I know Justin knows everything. So he's just going to say everything is cool. But I really want you to know what's going on here. I'm just going to ask quickly, do you understand why this would be not the highest risk trade for you? This one. Why it's not the best looking one? How far can it go past the EMA? Like you mean up here? Up here before you want to pull the trigger? Yeah. Okay, that's a good question. For me, I would take the relationship between that and that with regards to Fibonacci. This looks like a 50% retracement. I'm not going to go above 78.6. That's how far I'm going to want to go. Give me a second. I think these platforms are frozen here. Yeah. Can you still hear me? Look, I'm gonna have to reboot my system. Something is not working here. Okay, I can't move forward on this PDF. No, not PDF, PowerPoint. Oh, okay. Right, it was just the pen that I had to delete. Okay, so let me see. What is he? Dalvin says. Okay, Dalvin says you're finally teaching us how to scalp. What's the most you can? What's the most you can put your stop loss? Yeah, we're gonna get to the stop losses and the risk management later. So you've got no questions on why this is a not a good looking one, right? You fine with that example, yeah? Okay, so let's move forward here. Okay, so this is the same difficult example that we had, because if you look at your 120, it looks like this, but this is how your M3 looks like. But this is how your 120 looks like. It looks like a break up and a long. This is where prices are on your 120, and this is how it looks on your M3. So that's now another reason why this trade isn't the best looking. Right? This and this here is how it looked on your M4. On your H4. This is the same chart that we were just looking at. The long down move and then move up. This is how it looked on your H4. So another reason why the short wasn't that much of a good idea. Okay, Mark is just busy typing something. I just need to make sure that everyone is on board here with what I'm talking about. You just understand that this M3 is how it looks now, and this is what it looks like on H4. So H4 is pointing long in this case, and M3 is pointing short in this case. Yeah? In this example. And this is how it looks on your 15-minute chart. We were at support levels and everything is bounce off support and all of that. All reasons that's pointing against this trade here, your short trade. And even this year, this is advanced stuff here at the top here. We were supposed to come back up and fetch this level. That's the reason why this trade here was not a good idea, and the reason why you needed to take it at a less of a risk, but take it nonetheless, because it is a setup, it's a break and a pullback. Another reason why this M3 short is not good, it's because of the way it looks here. on your Heikin Ashi stuff, you have EMAs in the way. So a lot of things counting against it, but it's a setup nonetheless. Supposed to go back up there. We are at good levels on the Heikin Ashi. And it looks like this on your 4 hourly to try and get long. And it looks long on M12. So that M3 short has got a lot counting against it. And for that reason, you are taking the trade, but at a lower risk. And you're taking the trade because you do have a break here on M6, and you do have a pull, a breakout and a pullback of 50%, and you are getting your one candle there. Even though you got such a lot counting against this move, you are taking it at a lesser risk. It's following through now. You've taken your entry there, your stops are above there, and then it's come down. When you get your 1:1, then you are fine. All these reasonings for going along, it doesn't really matter now because you've got 1:1. You can break even. You can take all your profits off the table now because you know it's not pointing in the right direction for us anymore. We've got all of these things here happening. We've got, in reality, prices has come down here, but we know that we wanted to get up here eventually. We knew that this is an area that likes to go up because we are on our 633 there. We know that we are on a support level. It might just be a stop hunt to come down. That's what happened. Stop hunts to come down. Yeah. Stop hunted, and then probably eventually prices gone up. But you took your trade here at a lower risk because of all that reasons. So this is a difficult example. To alleviate all that difficulty, to stop thinking too much, is it a setup? Yes or no? Is it quality? Yes or no? And that quality is going to determine what your risk is. And eventually your plan worked out to get back up here, but after you've taken the profits there. Okay. This is the area prices has decided to turn, to come up and fetch the level that we knew was going to be taken. Yeah, eventually prices comes up and fetches that. But we've taken our profits down here. Yeah. We've taken our profits here at this break pullback. We weren't scared. We only took it on lesser risk. Eventually prices did come back up there first before coming down. Okay, this is that point there. Your M3, and that is that. Okay, do you understand that's a bit? You don't have to really, we're gonna go through more examples and stuff, and if it's difficult, we tend to leave it. We try and look for the most simple pieces of the puzzle here. We look for ones that looks good. If it looks good, we just take it. Yeah. Okay, so trade management now. This is what Richard was talking about. Like, what now? What do you do? So you find your break and your pullback and your entry. Your entries are minimum 2 candles, and in this case, your point is below your EMA, so that's good. Yeah. So it's usually about 15 to 20 pips is your stop losses. So that's my stop here. 5 pips plus the spread. My entries are here. Here's my entry candle. So it can come a bit lower, perhaps like a half a pip or 1 pip is my entry. And that's about 15 to 20 pips distance. And then 1:1. That is when we are stop ping any sort of counting. What I mean here is that we are considering that as a winning trade. How you manage it after that is up to you. But the 1:1 is all that we are calculating here. Then comes the management part now. 2:1. So we are taking, in this case, 2 trades, and you are taking your second profit up there, and preferably you have 3 trades on, where you have another block up there. Yeah. In this type of an example here, where you've taken this trade, the first one, and you got your 1:1 already. Yeah. And let's say you want to add another position to that now. You get another break and a pullback. You've got 2 candles. You need, in this case, your stop loss to be 5 pips below the EMA and not 5 pips below the point. In this case, it's 5 pips below the point. And in this case here, it's 5 pips below the EMA. Every time prices are above the EMA in a long situation, it's going to be 5 pips below the EMA. In this case, it's 5 pips below the EMA. Yeah. Now, Dalvin, in this case, is it 5 pips below the EMA or 5 pips below the point? In this case here. I want Dalvin. I know you, Justin. Just want to see if Dalvin knows what's going on here. In this case here, do you put your stop loss 5 pips below the point or 5 pips below the EMA? Yeah. And what about in this case here? Yeah, that's right. Usually, the best one that we are looking for, and the only one that we are really looking for, is the first one after the break. This is full risk if it's a quality setup. This here is always going to be secondary. You're not going to put the same amount of risk on the second idea as you did on the first. And usually the second ones are already in a trend, which means that your trend following EMAs needs the stop loss underneath that. Your first one usually has your stop loss underneath your point. And as it's doing its thing here, the pullbacks, you need to watch how deep it's coming down. The deeper it comes down, the better it is for me. Right, so this one needs your 5 pips stop loss, entries above there, and in 1:1 up there. Okay, that's a point example. And this is your first entry, so you're taking 0.3% risk here. This is your secondary entry, so you're taking 0.1% risk. And you taking 0.1 only if you've really taken your profits off here already. Don't come to the chart and take the second one if you haven't taken this first one. Okay, so now we're going to talk about risk, and particularly we're going to talk about risk when we are doing the fund management thing. This is the idea, and it's the lowest costing idea. Yeah. This one is the one where you get an account of $6,000 and your first goal is to make $60 by risking 0.1% on any trades and on all trades. So until you make 1% on your $6,000, you are risking 0.1%. It is to train you to take trades, and if you lose 10 trades in a row, it doesn't matter. And you keep on moving until you get to this first step of the goal. It allows you to teach, it shows you discipline with the system. It shows you that you are able to trade the system. If you have an account of $1,000 in that, then you can do your own sort of risking. But this is particularly if you are looking at doing the fund. Once you've reached this $60 on the 6,000, then you can start trading 0.2%. That's about $12 per trade on this on your $6,060, and the goal there is to get to $120. And then the third step here is you can risk 0.3 when you have reached your 2% goal. And this is like trading $18 per trade until you've reached 3%, which is now halfway, your halfway mark. And then the good thing about this is that if you've reached your halfway mark, you only need 10 more trades, and then you've reached your goal. 10 more winning trades, that is. I would just continue doing it this way, Richard, until you, irrespective of how many trades. So if you've just keep this risk in check. If you get 10 trades in one day, sometimes you get a lot of setups. Justin, how many setups do you get per day here? Justin is getting between 2 and 3 setups. And which pairs are you looking at for that? Justin is only looking at the GBP pairs and is getting 2 to 3 trades a day. So don't calculate how many trades per day and that you need, Richard. Just trade it when you see the setup and its quality. Just trade it, mark it down that it's a winner or a loser, and just make sure you stick to this, especially in the beginning. You will feel good making $60 by reaching or by trading only 0.1%. And there was another question here by Dalvin. Dalvin asked 10 pips. I don't understand that question. Can you just usually the entries and stuff, like if we look at this here, usually it's going to be between 15 and 20 pips. If you have a 5 pip, let's just go to this other slide quickly. That slide with the, here somewhere. Yeah, this one. If you've got Your entry above here. And that is your point. Yeah. You need to calculate from year to year what your stop loss is. And usually this is going to be like 15 to 20 pips on the pairs that we like trading, like euro dollar and cable and that. Yeah. So this is the gap here. So if this is 20 pips here, then your first target is going to be 20 pips. That is 1:1. If this distance between year to year is between your entry and your stop loss is 15 pips, then 1:1 is 15 pips. Right? Do you understand that, Dalvin? Profit is going to be whatever your distance from year to year is. Usually this is 15 pips. So your take profit is going to be 15 pips in this case. If the distance between year and year is 20 pips, then your first target is going to be 20 pips. Okay? Are you talking about the risk part of it then? Let's go through all of these again. That's your 1:1. So your risk, if this is your good looking trade, it doesn't matter. I said that you have levels of risk, but I want you at the beginning to only take 0.1% if you are going to trade the fund management account, just so that you can get that fund under your belt. The fund management thing works like this, Dalvin. Let me show you. I don't know if I spoke to you before. Let me see if I can get the pen up here. Yeah, so this fund, instead of having $1,000 account and using high leverage to trade it, which is not going to work, that's just a trap retail traders falls into. Instead of having that, you take your $275 out of that broker that you have. Yeah. If you have $1,000 account, take $275 and put it into the fund. Yeah. Put it into the fund. You get $6,000 to trade with. Yeah. Immediately after this deposit here, you get $6,000 to trade with immediately. Now, what I am suggesting is trade 0.1% on each trade. Yeah. Until you've reached 1% on this account, which means until you are managing to grow your account to $6,060, you are trading 1%. irrespective of how the quality of the trade looks like. Once you get that, then you are off your training wheels now. You know how to trade. You know you can make money with it. And once you know that, then you can start trading 0.2%. That is what I mean. Yeah, that is this. That is this here. 1% until you make $60, and then not 1%, 0.1%, then 0.2% until you make 1,620. And look at this. It's like this is $6 per trade idea. Yeah. So you only need 10 winning trades in a row to make that. Obviously, it's not going to work that way. But we don't know what the win ratio is going to be from this point on. We can only calculate backwards and say the win ratio was a certain amount. When Mark and I was doing it, it was 73%. That was from July all the way till the end of the year. What it is now, we don't know. And that was on euro, dollar, cable, and on the yen. 73% win ratio, but we don't care about that. We are working out what your win ratio is going to be from this point on. And this is the blueprint on how to make this thing work. The good thing is when it works, you get bigger accounts, and we don't need to talk about that now. Just do this at first. Make this your goal. Do you understand that, Dalvin, and the rest? Before we go over to Mark, who's going to do the psychology section for us. Very, very important. All the stuff that I just spoke about for 2 days or 3 days now doesn't compare to the importance of the psychology at all. Without the psychology, you're not going to be able to follow any of the things that I said during this period.